It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 3 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai as you're watching this. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live stream, Series 32, Episode 2, that's episode number 188 in the aggregate, starts here. Kumbaya happening all over the place in the US regulatory firmament, particularly amongst the CFTC and the SEC. Sharing the love in a GOP administration with such a fusion. It feels like the CFTC and SEC were having a Woodstock reunion. Trouble is, the focus surely needs to be more on legacy markets and not merely indulging the crypto kiddies' short trail that amounts to only a couple of the largest of the Magnificent Seven stocks' total market capitalization. At the same time, people who would love to just have one of the Magnificent Seven's market capitalizations, volume umpteen, the London Stock Exchange, according to the Telegraph of London. Their headline runs, the London Stock Exchange is on a long and sad path to oblivion. I'm not so sure it's that long a path, ladies and gentlemen. Meanwhile, in crypto, perhaps there is a popular influx looming as Walmart's OnePay looks to add crypto payments and custody to the wallet solution. And indeed, ladies and gentlemen, check out our social media over the course of the last week, or better still, subscribe to Exchange Invest, exchangeinvest.com, for updates on Young's pyramid of exchanges. Lots happening during the course of Q3, and the full rundown, which we gave a pricey of on social media, was in Exchange Invest, the exchange of information. Our guest today, ladies and gentlemen, is Paul Podolsky. The topic, a fascinating one for episode 188, the uncomfortable truth about money. Paul Podolsky is the founder of Kate Capital. He was for many years a strategist and advisor for Bridgewater Associates. If you haven't heard about them, you need to give them good Google, ladies and gentlemen. They are a biggie of great investment competence. Paul is the author of 3 books. His latest is The Uncomfortable Truth About Money, which is going to be the topic of today's discussion. Just a footnote to say, ladies and gentlemen, due to diary schedule issues, we've had to record this one. So we're really delighted to see you here. Please share some love with us, but at the same time, don't be surprised if we don't reply to you in the live stream, because actually we were talking to you from the week before last. Okay, Paul, greetings. Where in the world are you today?
I am in Westport, Connecticut. It's just a little bit north of New York City, overlooking out the window of our office, the Saugatuck River.
That's a beautiful place to be. Actually, I wasn't that far from Westport last summer at one stage. We were sailing not too far away from that general locale. So do you often go into Manhattan these days, or do you tend to stay in Connecticut?
Yep, I go there all the time. It's sort of for the type of thing we do, investing in money, obviously, Manhattan, there's a lot of interesting conversations going on.
I can imagine. So tell me a little bit, Paul. I mean, how did you get involved in the investment business in the first place?
It's not the most direct path. So I graduated Brown University in 1991, and most of all, I was interested in having an adventure. And at the time, the Soviet Union was collapsing, and I was able to get a job there and became a foreign correspondent. In the collapsing Soviet Union, I came to the belief that prices, the mispricing of everything there, was the fundamental issue that whole union collapsed. And I got very interested in prices from that point forward. Got a graduate degree in economics, worked on a trading floor for 6 years, worked at Bridgewater Associates, the biggest hedge fund in the world, for 16 years, and then started Kate Capital.
Fascinating. So you got a background in writing, we moved into investment management, and you're still writing books as you go along. So tell us a little bit about then Kate Capital. How does that work and how is it structured?
Kate Capital is a discretionary global macro hedge fund for institutional investors, not for individuals. What that means is we trade stocks, bonds, currencies, and commodities, both long and short. And the goal is to have a reliable investment return no matter what the environment. So if equities go down, we have techniques that we try to use to make money. If equities go up, same type of thing.
Fabulous. Very interesting altogether. And sorry, remind me again, you were just saying you've been in business now, what, a couple of years with this fund?
Kate Capital opened in, that we began managing client money in November 2024. So we're just coming up on a 1-year track record.
Fantastic. Well done. That's a very exciting issue altogether. And tell us, a little bit about the journey. What's it been like setting up your own fund?
Oh, fascinating. The whole thing that motivated me from the get-go of leaving college and going to Russia and working as a correspondent up until the present day was continuous learning. I just wanted to constantly put myself in positions, sometimes uncomfortable positions, to try to keep learning. And even though I knew a lot about investing and a lot about talking to institutional clients about what's going on in the world and portfolios, those are things I did for years before this, I never created a fund from scratch. And that involves picking a great team of people to do it with you. It involves everything you have to know: IT, legal, regulatory, back office. You have to get familiar with a whole suite of things that I was not intimately familiar with before.
Yeah, global macro takes on a whole new meaning when you're trying to put together a fund. You suddenly have to be a global macro manager just of all of the elements that come together to make a fund.
Yeah, it's the investing I've done for decades, but for instance, everything that happens after you make a trade, to the point that it settles and that is confirmed by a third party and that it's accurately recorded and communicated to the client, all of that were issues that I had to get a different degree of understanding than I had previously. A hedge fund sounds like a very exotic thing, but at the end of the day, it's just a business. You're making a certain amount of money, you've got a certain amount of expenses to make it run, and you've got to run it just like a small business anywhere.
Yeah. That's the thing. And I think a lot of people, don't tend to think about the fact that hedge funds per se are not necessarily huge businesses in terms of they can have a lot of assets, but they don't always tend to have that many people actually on the payroll doing a multiplicity of jobs.
That's right. We're managing meaningful institutional portfolios right now. We have 7 people doing it. So it's the volume of money you're managing is large, but the actual amount of people you need to do it is relatively modest. And that's a shift in the nature. I know part of your show is about the evolution of financial markets. It's a real shift in the nature of productivity in financial services. You can do way more with less now.
Yes, it's something quite interesting. In fact, we were discussing quantum finance on our last show, and that's quite interesting because obviously the whole way that machine learning and artificial intelligence has allowed us to gather a lot more data a lot faster has certainly improved one side of the business, where before you used to need to have realms of human beings all doing the analysis for you, and you can now manage to compress that, although you still need human element at the top end.
You do need a human element, but part of what we do is, you're right that there's been a huge increase in the amount of information that's available. If you just take a statistic like the U.S. unemployment rate, now there's so many different private sector surveys that are out there that purport to show different angles of what's going on in the labor market, and you must incorporate those. So we have amalgamated all of that information into internal perspectives that we use, which does take people to do, but those people are so much more productive than they used to be. If you listen to the earnings reports of the big Mag 7 stocks in the US, Google will tell you that they're now doing 30% of their programming using AI. And that's why the unemployment rate for software engineers is so high. We're doing the same thing. So we've got really brilliant technical builders inside K Capital, but their productivity is way more than it would have been 5 years ago.
Yeah, it's been a huge shift in every possible way through those sorts of markets. So, tell me one thing, because obviously, Paul, you come from this very, very interesting point in 2 ways. Geographically, coming from the Russian market, but also at a point when the Russian market itself was both, at one point it was exploding and the next minute it was imploding. I'm just curious, what's your kind of mix these days in terms of how much time you spend looking at what we might still call the emerging markets, or at least the non-Western markets, and obviously the big kahunas like the US itself?
Probably about 2/3 of the developed world and a third or maybe a quarter of the emerging world. And the part of that is we do spend a lot of time looking at China. We do have some investments in China, but the bigger thing is China is the second biggest economy in the world. And if you're a macro investor, you start off with a view of what's going on in the world overall, you really can't have an informed view unless you have a clear understanding of China. That said, my experience in emerging markets is, as you're referring to, not theoretical, it's practical. Living in Russia for 3 years, spent a ton of time in China, I've traveled to other places widely. So I think that emerging markets are fascinating. The threshold for having them in your portfolio, though, for me is quite high. There needs to be something exceptionally compelling to justify it, because many of them have a more unpredictable regulatory environment.
Yeah, it's so interesting, isn't it? I mean, having done more than my own share of frontier and emerging markets over the years, it's fascinating how, for all we talk about the greater productivity of AI, et cetera, we have to be incredibly careful, because there can be a huge gulf simply in information, let alone, as you say, the regulatory firmament, the legal firmament, when you're dealing with a lot of these markets compared to the USA.
Yeah, I mean, the case study for that is Russia. So if you look at the Russian stock market from the time the serfs were freed in the mid-19th century up until the 1917 revolution, Russian stocks actually keep pace nicely with American stocks and are lowly correlated. So from a portfolio diversification standpoint, in 1916, you would have said Russian stocks have to be a part of your asset allocation. And then came 1917. We've gone through the same boom bust in Russia again in my lifetime. When I moved there in 1991, all the way up, they had an unbelievable run, and now Russian assets are once again uninvestable. So the volatility in these markets is really fierce, and certainly Russia's invasion of Ukraine puts that into very sharp focus.
Yeah, well, I mean, obviously the whole geopolitics of Russia's investment of Ukraine is one thing, but even before then, it was proving very challenging, despite the fact that, to be fair, the Russian investment architecture, the investment structure of 2010, 2015 was materially, I mean, Seven Sigma better than what you were looking at between 1991 and 1995. But nonetheless, it has been very, very troublesome. And a lot of investable, supposedly, emerging markets do still come with those sorts of difficulties.
Certainly. So Russia, going into the invasion of Ukraine, had very high real yields on its bonds, low fees on its stocks, the currency was suppressed, all of that. They would check the box from an investment perspective, but you had to deal with the possibility that you would see this absolutely inane policy to invade Ukraine and murder, huge amounts of innocent civilians. And so, and then the sanctions get applied, et cetera. So you have these tail risks in emerging markets that are just extreme. And a more mild version of that, of course, is people have been very excited about China's boom. And you would think that Chinese equities ought to be a fantastic place to be. In the recent months, they've been well. But over the long term, they've been a terrible investment for one reason only, which is that the Chinese have issued an enormous amount of shares. So as the U.S. companies have been buying shares back, they've been issuing. And that explains a lot of the difference in return.
Yeah. That's a fascinating dynamic, and it's very interesting to go on the ground in China, because if you arrive having not been there even for a number of years, as was the case actually with myself and my late wife in the course of May, it was incredible because you get there and you think, my goodness, this is the most incredible economy on earth. And then you think, yeah, but the stock market's been collapsing and flatlining for the course of the last year at best, precisely because things had got so wildly out of hand, even if living standards have improved immeasurably and there has been economic growth, albeit I suppose we could then debate what that economic growth has been compared to the official statistics.
Yeah. Yes, and so and it's through experiences like that, and also the ups and downs in developed world economies. That was the key idea I was trying to convey in The Uncomfortable Truth About Money, which was we all want something out of money that provides a stable return over time, that allows us our savings to grow at a rate faster than inflation. But the reality is no single investment is stable and reliable. It just doesn't exist. And the emerging markets are an extreme example of that. But you can see the same thing in developed markets if you just look at who the top companies were by decade. They almost always shift. And what they do, if it happens unexpectedly, there can be great capital loss. And that is the reality, that capitalism over time provides unbelievable financial returns, but once you really look at the individual components of them, they're all so unreliable.
Yeah, and I mean, you hit on a great point there because obviously looking decade by decade, the point I always like to point out is the fact that yes, it's a great idea to invest long term in the stock market, but if in the middle of the roaring 20s you'd gone into a hot stock like the Stutz Motor Company, then things haven't been looking terribly good for you during the course of the last 90 years. So talk to me. You did a beautiful segue there. We're speaking with Paul Podolsky today. We're talking about The Uncomfortable Truth About Money. Your book, The Uncomfortable Truth About Money. What caused you, what was the genesis of this idea to write this tome?
It initially started out as something for my adult children. When I grew up, I knew nothing about money except to spend as little of it as possible. My father worked for the government. He was a scientist, and one of the reasons I think he chose that work, he loved science, but also he was a child of the Great Depression. And he saw how vicious income instability can be in a depression like the one you're referencing. So I didn't know anything about money growing up. Once I had a family, I was initially starting out as a journalist, couldn't earn enough money to support my family, and was like, I'm going to have to figure out money. So this began a long quest that combined with the curiosity I had about what I saw in Russia to understand money. Now I'm in my 50s, my kids are adults, and I was like, I don't feel like they know much about money. Let me try to jot down what are just the most key things I've learned over time, convey that to them. But I was like, it probably ought to work for anybody that feels like they need to know the basics about money and is a little bit skeptical about the standard advice they get.
Yeah, I mean, it's a fascinating issue, isn't it? Because materially, and I'm sure some people are going to be watching this who are money advisors, but materially it seems to me that the overall standard of advice doesn't necessarily improve given the quantum of how markets have changed over the course of the last 20, 30, 40, 50 years. And it's certainly very interesting. So walk us through this. I mean, what is the most uncomfortable element that we should be thinking about in the truth about money?
Instability. That everybody, I think that makes people uncomfortable. They don't like it. People can handle a certain rate of change, but when change is faster than that, they get full of angst. And I just think that's how we're wired. So a lot of people don't like to think about money at all. They certainly don't like to talk about it. You can get much more information about what sort of sports people do or work they do than to actually tell them how much money you have and how much money they have. But despite that discomfort, you're going to deal with money in terms of your income. You're going to deal with money in terms of your savings. And if you borrow money, you're also going to deal with money. So those three vectors, income, borrowing, and saving, are something that touches all of us, and it's inescapable. And so what I was trying to do in the book is give you a framework just to understand how those three parts work.
And okay, so you've got this framework of the three parts of how it works, and therefore the book is it aimed specifically at your children's generation, or is it aimed at anybody old or new, young, old, adult, non-adult?
I tried to make it broad. One of the things I've learned through my books is you want to make it as broad as possible. So I had it, the money also is a boring topic for many people. It's much more interesting to think about romance or spy movies or something like that. So I tried to interject the book with a lot of personal stories. Each time I learned a money lesson, even though it might be an abstract lesson about how best to save, I tried to inject the story with the moment in time when I learned that, who I was talking to. So in that sense, my aim is to have something that's much more applicable to a broad audience.
And it's interesting because obviously, I mean, you're talking about your parental arc, which was obviously quite fascinating. Your father being born in the Great, or living through the Great Depression, obviously seeing the terrible penury that could exist then. But your own money arc is fascinating because, as you say, those who were journalists in Russia in the early 1990s, even if you were working for the Western press, were not necessarily generously recompensed compared to certain other professions like Wall Street, for example. So, I mean, what's one of the big lessons you've learned on what has been a remarkable journey, not just across continents, but across balance sheets?
Focus on what is, first of all, not what you would like it to be. So I started off being a writer, and part of the Russia experience was to have a Hemingway-like experience. He drove an ambulance in Italy in World War I, and then I was going to become a foreign correspondent. But the time that I began to get into that profession was the time when the internet was beginning to destroy the cash flow of a lot of the big media companies. And this is a normal thing that happens. It's happening right now with automation. There's a lot of people that have driven for a living. They might drive a truck or a forklift or a cab. And those jobs are all getting rapidly replaced right now by robots. And it's starting, and it's going to accelerate. The number of American cities right now with automated taxis is growing. In some places, Norway, United Arab Emirates is already, much more advanced. And so, what I learned is, even though I had these images of what being a writer would be like, it forced me to live in very frugal circumstances. I opened the book with the story of watching these rats walk back and forth in front of the apartment building with my son. And so it forced me to just think about, well, forget about what you wanted, Paul. Think about where the cash flows are moving in society. What forces are getting them to move? And you're going to have to move with them, Paul, even if you're not that enthusiastic about it. Because if you're on the wrong side of one of these technological changes, you could be the most thoughtful person in the world, and it's going to be really tough to earn a living.
That's a very interesting lesson, but it's one thing that I think a lot of people really struggle with, because you're talking therefore about people having to be very flexible with their lives. And I mean, you paint a great picture. The idea of the journalist and the foreign correspondent is something that, particularly for our generation, is lured in romance. The idea of being Hemingway or being one of those, amazing female photographers that lounged in Hitler's bath at the end of the Second World War, getting photographed and so on. There's so many incredible stories, and it seems so amazing. And of course, the most important point was they actually had expense accounts that were probably more lavish than the salaries of today's foreign correspondents. So it's a huge change. And that's a very
interrupting for a moment, but you maybe saw this film. I saw this when I was a teenager, Year of Living Dangerously. And it was all about, a journalist in Jakarta. I was 15 years old or something. I was spellbound by this. I thought it was so cool.
I'm totally with you. I mean, it's all that sort of fascinating thing, and the lure and the excitement of going to, whether it was Jakarta or old Hong Kong or something like that, and how incredible these places were. And indeed, to this day, I mean, the Foreign Correspondents Club of Hong Kong, which remains one of the most elegant clubs in the entire place. But I don't think any journalists can actually afford to be members anymore, virtually. So it all ended up being bankers who claim they were stock analysts in order to manage to get elected in the first place. It's a very, very interesting thing, because that remains to me a hugely difficult thing to explain to people, which is, that thing you got in your heart that you think is going to drive you. And actually, let's face it. Sorry, I'm going to go on a quick monologue for a minute. But one of the things that is the worst thing, if I may say so, from the sort of plutocratic billionaire class is they all go out and they all go out and lecture MBA classes or wherever, and they all go, follow your dreams, children. And then you find out that they made $1 billion out of, working on, chicken fertilizer, for want of a better term that we can get away with, which I don't think was in your dreams when you were 14 years old, Mr. Chicken Fertilizer billionaire.
Yeah, and it is a tough lesson to learn. And I think it's a balance. So, the writing, trying to explain the world, understand it, still motivates me very much. But I felt like I had to adjust that curiosity to the reality of present day cash flows. And it was a bumpy process. There were many times when I felt uncomfortable with that. But then when I look back at the history of markets, the rises and falls and shifts in wealth, I believe that is something that many, many people are living through all the time, and it just becomes more normal. And I think one of the things that people like about the book is it talks about that, but I also think if I'd just written the truth about money, as opposed to the uncomfortable truth about money, maybe it would have drawn even more people in. Because the minute you say it's uncomfortable, it's uncertain, a certain percentage of people are like, yuck, I want certainty.
Well, that's also true. But on the other hand, I mean, money is such a polarizing thing when you say the word money, because everybody somehow or other, on one side, everybody sees it as a positive because they know that they need it to pay for their food and this, that, and the other. But at the same time, it just puts so many people off because for whatever reason, they have a very quixotic relationship, to put it mildly, with their money in the first place.
Yeah, I feel like it's to take two extremes of it. People who feel like they don't have enough, and I remember when I did not have enough, the feeling I had was that I'd done something wrong, that I'd made a mistake. How come I couldn't afford a decent apartment for my family? It was very small, it had a bad odor, it was just unpleasant. So if you don't have enough, I think there's discomfort that somehow it's your responsibility. And then for people who have a lot of money, I think that they worry that other people will envy them, other people ask for some of their money. And so along the full spectrum, there is discomfort all along. And as I said earlier, people are very loath, or most people are very uncomfortable to actually tell you what their financial situation in detail is. It's like the deepest of secrets.
Yes, and it's also quite interesting when you look at people's financial situations, because let's face it, and from what I can recall of being in Connecticut, it's not immune to this situation. The classic tale of you don't know who's swimming naked until the tide goes out is so true, because it seems to me that everybody, in order to achieve an acceptable lifestyle, all has to be driving a particular kind of Mercedes-Benz or BMW, but you actually have no idea how many of those people could pay for it out of petty cash, or how many of it are leasing it and just about making the payments at the end of the month.
Yeah, exactly. And if you look at, the Federal Reserve has good nationwide statistics on what people's financial situation is. And even though the United States is obviously a comparatively wealthy country compared to other countries, what you see is a relatively high percentage of people, according to Fed survey data, if they had an unexpected expense of something, $500, call it, it's slightly different, but call it $500.
Yeah.
They would be hard pressed to meet that. And so if you think about that, it's like, well, why is that? Here's this wealthy country, but huge parts of the population feel financially strapped. And because for a period of time I was in that situation, for me getting very clinical about mechanically what's happening. How come my income is like this? How come the goods I'm trying to buy, like medical care, cost that? And writing it down in a spreadsheet and just seeing what those numbers are, for me, it helps me move from the very emotional response to money that anybody has to a more analytical, logical approach to money. That doesn't mean that money will at any point not be emotional. It'll always be emotional, but at least it helps move it into an area where I believe it can be thought about more logically.
Yeah, and you raise a great point there by talking about actually medical care, because let's face it, you're saying whatever that number is in America, but it really is wafer thin, because $500 or $1,000 barely gets you the clipboard to sign when you're going into hospital in most states of the USA, let alone actually any treatment. So it's always going to be an issue if people haven't got enough coverage, whatever that number is. And I know that it is remarkably wafer thin, that it's only a relatively minor incident of significant plumbing or something like that could actually materially impact a lot of American citizens in the richest, greatest economy the world has ever seen, which is quite shocking.
Right. And so yes, that's right. And one of the concepts I talked about in the book is, if you think about these things, your income, your spending, your borrowing, your saving, each of them has a volatility to it. So what you're raising is an emergency medical situation, and then all of a sudden it creates a volatility with your spending and a volatility with your income. And for me, it was very useful to be able to put into perspective how volatile those things could become. So becoming a writer, a journalist, at the same time that journalism was entering into a very, very difficult financial situation, that seemed shocking to me at the time, until I look back at income overall. It's constantly doing this. Think about the way people were who were experts at making carriages and saddles and bridles for horses at the beginning of the 20th century as automobiles came around. All of a sudden, all those professions got wiped out, just like people who drive right now, it's going to get wiped out. So there is a volatility to your income, to your salary, and that's inescapable. And places that have tried to remove the volatility, like the Soviet Union or like North Korea right now, the costs of trying to remove it are so much worse than any particular benefits. You can't get away from it. So if you're living in the modern world, you're living with volatility. The same way stocks can go up. They've gone up a lot this year, 20%. They could easily fall 30, 40, 50%. That's normal for stocks. And so being aware that these key moving parts that we're all exposed to have this fluctuation to them, that it's inherent, for me, that was a good piece of understanding.
Yeah, and I mean, you hit on a great one there, which is the truth is that we must let innovation flow, because if we don't let innovation flow, then the economy atrophies. To wit, one of my favorite economic statistics, which is to point out that K-pop, which involves essentially 500 to 1,000 pretty young boys and girls from South Korea, that whole industry generates about the same as, I think it's about 18 to 20% of the entire GDP of North Korea, which, as you've said, the DPRK has spent a great deal of time trying to stop these sorts of income inequalities and all sorts of issues happening. And the result has been impoverishment to the point where a bunch of pop stars that pretty much nobody in most of the world has ever heard of, no offense to those who are, of course, huge fans of Blackpink, etc., can manage to be so economically successful through innovation.
Right. And so the aggregate process of there's change, there's what economists called creative destruction, that's required to create wealth. People, I think, many times agree with that in theory. It's then when it affects them personally that they all of a sudden begin to get challenged by it. I was looking today at the employment for major companies in the United States like UPS and FedEx, and they've seen abrupt declines in employment because of automation. And so I think in concept, people agree with it. In the specific, it's harder. And I would even go so far to say as the political tension you're seeing all over the world today, the United States has swung to the right, the UK has swung to the left. I suspect that the core issue globally is that this particular set of economic changes that we're in the middle of right now, the automation, makes people wealthy, but also makes many millions of people uncomfortable. And then they put pressure on the political system to make me comfortable, but the political system can't make them comfortable. And that is the reason you see the political instability, US, UK, France, Japan, etc.
That's a very good point. And it's a very, very interesting one, which we're going to carry on in the conversation in just a couple of moments. I'm here with the absolutely fascinating Paul Podolsky. We're talking about the uncomfortable truth about money, and we're having a great roam around the macro world of investing. And in fact, one of the points Paul was just making was, what happened to the people who were making horses and carriages and saddles and so on for horses? Well, the answer is the ones who succeeded actually succeeded exponentially by modifying their business model. Nowhere was that more obvious than in the case of Hermes, which is the topic of our short video of the week. In big world, I've always thought a great argument against private jets was the Birkin bag. Not that I'm averse to private jet rides being offered, but sometimes it can really make sense commercially to get out there and meet the people, as it were. This was the gestation of the Birkin bag, now a source of vast cash revenues, perhaps $150 million per annum, and they restrict sales to Hermes. In 1984, on a flight from London to Paris, the Hermes CEO, Jean-Louis Dumas, was seated next to a basket carrying Jane Birkin, the famous model, chanteuse, actress, etc. He bemoaned the lack of a suitable handbag for dynamic fashionistas like her. As the story goes, Dumas got to work sketching on napkins in flight. The original Birkin was given to arguably Britain's most famous export to Paris, and Le Birkin sold hers a decade later at Nade's benefit. The handbag sold again in 2000 AD for an undisclosed price before making a fairly staggering $10 million, including fees at Sotheby's in Paris earlier this year, to a Japanese bidder. And in case you haven't gathered, that was the highest price ever paid for any handbag at auction. For more in Big World, like or follow. And I must admit also, as a footnote to that, I'm actually really impressed by Mr. Dumas, because first of all, the flight's only about 1 hour long. He managed to sketch a new handbag, and second of all, he managed to sit beside Jane Birkin and actually manage a conversation, whereas I think I would have probably just been sitting there incapable of saying anything. Our book of the week this week, ladies and gentlemen, moving on from saddlers who've gone good in the luxury products world, is The Essential Guide to College Financial Planning, How to Pay for College Without Going Broke, by one of our former IPO-VID guests, John Ensley. He reveals the new secrets to beating astronomical college costs, something which may come as a great relief to a vast number of people who are coming to the uncomfortable truth about education. Although at the same time, I'd have to say I'm not necessarily sure that education these days is, well, worth the money that it was even when it was priced 20 years ago. However, that might just be me in a changing world. I'm here with Paul Podolsky. We're having a really gripping conversation. We're discussing the uncomfortable truth about money. Paul, it is interesting. I mean, when you look at the whole thing, because actually education is a bugbear of mine, because it seems to me that in the United States of America, you now pay a huge amount of money to go to a university to get a Rolodex, which comes with an education, which may or may not actually be, the education actually is probably not the most important component anymore. And I'm just curious, I mean, in a changing world, what's the uncomfortable truth about money and how you ought to be spending it on education, given the fact that you yourself mentioned you're a lifelong learner?
It's a very important decision, and the cost, particularly in the U.S. of education, just skyrocketed. The concept I shared in the book is that there are castes, K-A-S-T-E-S, in society, and then there are castes within castes. And this is one of those things that shouldn't be that way, but it is. For me, when I switched from being a journalist to a banker on a trading floor, that was switching my caste. And then switching to work at Bridgewater, a hedge fund, was also switching my caste. And leaving Bridgewater to start this was shifting caste. Shifting caste is hard. Education is a part of that. There's many jobs in modern society that you can do without an education. Bill Gates, obviously, has gotten very far without having a college education. Unfortunately, however, in the sorting process of selecting jobs, education really matters. So it's a choice. There's different ways to do things. You don't have to have, I've got two children. One of them has a college education, one of them doesn't. So you can choose your path. But what I talked about in the book is just be aware of the consequences of it. When it comes to getting education, from a practical standpoint, I would say get the best certificate you can for the lowest cost you can. It's just a trade. You're trading your money to get their certificate. Yes, it's an experience with other students, etc. But I would be very mindful of that. And if there's a way of trying to get a certificate at a little cheaper cost, I would take it.
Yeah, it's an interesting one. I mean, I lectured a bit at Nicholas Copernicus University in Toruń in Poland, which is a fabulous university. And one of the things I noticed about that is overseas students studying in English in Poland, which was a rounding error 25 years ago, was about 2% about 10, 15 years ago. It was now about 7% of the entire number of people who are being educated in the Polish university system. And you got to turn around and say, it's actually a very good education. Two, it teaches you a heck of a lot more living in Poland than it's going to teach you living in, I don't know, Reading or some dormitory city outside the UK. And just to compare it to UK numbers, which are not astronomical compared to US numbers, you can actually manage for less than the college fees in the UK to live a very reasonable lifestyle and pay your college fees for a slightly longer degree course in Poland, which I think is a win-win and still gives you the qualifying token, as you say. In fact, makes you a bit more unique because you turn up with something that's not from Reading University or some other equally cutty cooker boilerplate kind of university in the UK.
Yeah, I agree that, in the United States, there's state schools versus private schools. The private schools, the terminology is different in the United States than it is in the UK. They've gotten to be very expensive. And I also agree with you that there's different forms of education. I got a college degree and I got a graduate degree, but the education, quote unquote, that I had by living in Russia for those 3 years, I feel like I learned more there than I did in college, precisely because of what you were describing. It was also unfamiliar to me. If you're in a place with a foreign language and you're forcing yourself to learn that foreign language, that opens a whole door. It's sort of minute by minute work. So I would look at education broadly, but in a world where people are working all over and competing for jobs, et cetera, those certificates do matter.
Yeah, the certificates matter, but as you say, the broad experience is vitally important as well, because I think I would quite happily trade my several-year stint on the board of a central southeastern European oriented all the way through Russia and the Stans private equity fund for pretty much everybody's MBA. It wasn't quite as elegant coursework, but it was nonetheless an experience that stands you in remarkable stead for corporate governance the world over. So when we're looking at these uncomfortable truths about money, I mean, when you're taking away what you've got to do, you're giving us a very high level of thought and analysis, and you're asking for people to change quite a lot in terms of how they look at the world. They've got to be a lot more flexible. Is it the case that people can look at being flexible at one inflection point, or do they have to be rather like great geniuses like Copernicus himself, they've got to look at maybe 3 or 4 careers during the course of a 70 years and 10 lifestyle.
Well, first of all, I wouldn't put myself in the position of preaching to people about how they should live their lives. Everybody's got to find their own path. What I was trying to convey in the book was that certainly live your own life, find your path, but money is going to have a force unto itself. So if you are lucky enough to have savings, if you spend less than you earn and you put that money, all of it into the stock market, as you said at the opening of the show, it's completely normal for that stock market to fall sharply and those savings to be destroyed. So for me, when I looked at the pros and cons, I was like, I am more comfortable being flexible with my career and flexible in terms of how I invest, not sticking to any one regime and evolving as conditions evolve, rather than face those risks. So unfortunately, there's not an easy solution. It'd be easier to say, I'm just going to stick with this one profession, and if the salary drops from it, I'll just deal with it. I'm going to stick with this one savings program, 60-40, 60% stocks, 40% bonds, and if the stock market gets hammered, I'll just live with it. There's a certain appeal to that. It's simplifying. For me, it wasn't satisfying. And so what I was trying to convey, because I read so many of these books that are like, if you follow these 3 practices, you'll end up in a good situation. And I was like, no, you won't. Like stocks for the long run, that's worked in one country and one country only, the United States. In many other countries for decades, that hasn't worked. So I'm being a little bit wordy in the answer, but I feel like you don't have to be like Copernicus genius, but just recognize the consequences of your actions. If you're inflexible, it exposes you to a certain set of outcomes. If you're flexible, it's hard. It's going to cause you more nerves, but exposes you to a different set of outcomes. Just make your choice.
Yes, make your choice and manage to be flexible, though, at all points in time. I think that is the key thing that's important, because as you say, yeah, buying stocks for the long run, that's always going to work out, as you say, really has worked incredibly well if you pick the right 50, 60 years in the United States of America and pretty much nowhere else. And it is so interesting how people fall down into these sort of guru rules where they are trying to preach to people what they should do, yes, as opposed to where you're trying to gently chide and advise people as to what you think might be a reasonable approach.
Yeah. And that's one of the things that I love about investing and doing this long periods of time is that many people have opinions about a certain thing being true, but it's very difficult to prove that idea. I would say that the notion, for instance, of political correctness, which became very popular when I was in college, that was sort of an idea that was like a bubble. It took an awfully long time to pop. Investing tests your ideas all the time. And great investors like Buffett or Soros, these types of people, they're wrong 40% of the time. Stunning. It's the 60% of the time they're right that's led to their wealth. What that means, though, is they're getting constant feedback on decisions they took that were obviously mathematically wrong. They bought X thinking it was going to rise in value, and it fell. And so that process, being in that for decades, I feel like has helped. Some people say like a yoga practice helps them get physically flexible. For me, investing has helped keep me, I think, mentally flexible, because you're constantly having to reevaluate your thesis and see the flaws in your thinking. And all of our thought is somewhat partially flawed, and it's getting comfortable with that reality, recognizing the mistakes, then quickly adjusting, that led to the outcomes like you were describing of Pear Mates. That's exactly that process, being like, listen, our family has a long tradition of building these unbelievably craftsman-like things, but we're doomed if we do that. We need to pivot this direction, and they made a radical pivot.
Yeah, absolutely. And I mean, they ended up being a business that had traditionally made scarves that went alongside the saddles. And nowadays, saddles is a rounding error in their overall business model, although you can buy them. And the Hermes scarf has become something that, well, let's face it, what can we say? You can buy your Hermes scarf right outside the door of the New York Stock Exchange. And what does that tell you about the sort of people who are going to be buying Hermes scarves? So it is, yeah, it's a very, very interesting structure. So looking, where we are at the moment is interesting, though, I think, because we are in a period of incredible change. And yes. I'm not sure, would you agree with me that we're in a period of much more considerable change than we have been necessarily in a lot, not all, but a lot of recent decades?
Yeah, I think we're in the early stages of one of these abrupt shifts in the nature of how we work. There's been about five of them in the last 250 years. Railroads, canals, combustion engines, electrification, and then computers. Each one of these things radically shifted the way we lived, and it's affected my life. When I was a young boy, we trained at learning how to use a typewriter. I don't think you could find a typewriter anymore. Maybe in some antique store. So I've seen this already, and I remember growing up that my father and grandfather took pride in their ability to repair their own cars. Knowing how a combustion engine worked was considered sort of part of a rite of passage. I think within my lifetime, nobody's combustion engines are going to be just like saddles. They're going to be something of curiosity. Somebody who's a car aficionado might take their favorite combustion car out, but that's all going to change. So you're right that we're in one of those periods. And so we now need to make those adjustments. And I can imagine that if you are an undergraduate right now in a university anywhere in the world, you're really asking yourself these questions. The hot professions of just 20 years ago used to be considered, if you were a computer programmer, might not have been the most exciting work. It wasn't being a foreign correspondent in Jakarta, but it was reliable. That's no longer true. And that's going to happen with many, many jobs.
Yeah, it's absolutely fascinating altogether. And as someone who is a car nut and sometime race car commentator, I have to say I spent part of the weekend in London last weekend with a car which eventually ended up leaving us with a lot of gunge in the float bowl as a result of slightly soggy fuel. And if you think I'm speaking Martian, this is not part of Duolingo's Martian course. That's Cars 101 from the 1960s, children. No, it's a great point, Paul, because yes, so much has changed so much fast. And I think the point you really make well is the one about driving, because you look at the Middle East. Not only are they going to lose drivers very quickly, but actually they're going to have autonomous helicopters coming to Dubai and Abu Dhabi in the course of the next 18 months to 2 years are going to be delivered. So you'll be able to move from emirate to emirate or to and from the airport without actually encountering a human being to transit you at all. And you'll go through 3 dimensions, not merely going through 2 sort of on a linear highway. So when you're looking at this, okay, help me understand from the perspective of the book, meditation, a Zen-like attitude towards change. How do we prepare ourselves for this change so that we can at least manage to, if not garner the maximum impact from them, find ourselves not on the wrong side of still being in the typing pool when word processors have become the thing?
I think it's 2 steps. The first thing is even though the notion of rapid change is anxiety provoking, we all have to do what we can do to be as calm as possible. You make better decisions when you're calm. So all these things that could sound like fluff, but sleep, meditation, seeing friends, exercise, healthy food, all that type of stuff, it really matters because you want to be in as calm a state as possible when you're making these decisions. That's step 1. And then step 2 is, for me, just mechanically think about how these things work. And that's what I was trying to do with the book, is lay out mechanically how the income, spending, borrowing, saving work. So take your example of flying helicopters. Okay, what is that? All right, it used to be that I would be renting a car to get from A to B. And now does it seem like I'm going to be renting a car? All right, do I have my money saved in rent-a-car companies? That wouldn't be a good idea. Then there's going to be these new helicopters that are going to take me around. What is that going to do to the cost? That's going to relate to inflation. Who are the companies that are making that? They're going to begin to get the profits. It's going to go away. Just thinking mechanically when there's a change, just break it down into its parts and think about how it affects you.
And I have to say, the momentum of this conversation has been so fantastic. We're rushing up towards the end of what has been a thoroughly intriguing session. I hope we can actually get together another time, Paul, and discuss further matters of moment. But when you're looking at this wondrous analysis of what goes on in the world and how we're going to look at the future, I suppose I've got to ask you one question, which is, Paul Podolsky, where do you think the capital market revolution goes next?
I think that what we're going to see is a bifurcation between traditional assets and more non-traditional assets. So the things that are going on with Bitcoin that I know capture many of your listeners is, for me, it's also like new technology that particularly works well in emerging markets. So there's been developed markets where all the capital has been, and then there's been these emerging markets. We've talked about had these booms and busts. I think the most practical application of new digital assets is providing monetary policy for the vast majority of the world that is exposed to terrible monetary policy. So I'm thinking about big chunks of Latin America, big chunks of Africa, certain parts of Asia. And so that is a huge change in the technology of banking. And I think it puts huge strain on the existing legacy systems to this new system that is developed. And then simultaneously, there's clearly a huge east-west tension at who is going to control capital markets, because the epicenter of the U.S. power is U.S. capital markets. And you're seeing that whole system begin to shake now with the autonomy of the Fed and this new technology that allows emerging markets to sidestep their own central banks.
And on that note, ladies and gentlemen, this has been the uncomfortable truth about money, an absolutely gripping conversation with the magnificent Paul Podolsky, someone who has himself undergone quite the arc of a journey from watching the rats in the street in Russia with his son as a journalist hoping to espouse Hemingway, and made it all the way to the hedge fund firmament of Connecticut. Thank you very much, Paul, for being our guest. Next week's guest is being teed up because we're recording this a couple of days early, ladies and gentlemen. Thank you for staying tuned during the course of this episode. We will have another fascinating author coming up actually in our next episode, I do believe, but we're going to do the prep call with him tomorrow at the point when I'm recording this. It only remains for me to say, don't forget, catch up with the ongoing world of the exchange of information, what's happening in the business of bourses, Exchange Invest via exchangeinvest.com, because that pays our daily salaries. And let me thank you all very, very much, ladies and gentlemen, for watching today. Also to our fantastic production team. Thank you very, very much, Jamil, Marianne, and Racy. My name is Patrick L. Young, and don't forget, if you're looking to have your next marketplace or exchange built, get in touch. I wish you all a great week in life and markets.